Hello everyone, welcome to today's US Open live webinar. The time is 14:20 GMT, 10 minutes before Wall Street opens. This is your host Nikos Tsabouras, Senior Market Specialist at FXCM. Today we've got quite a few things to talk about. Less than an hour ago we had the latest CPI inflation data from the United States, which showed another small moderation, but were worse. They were actually higher than expected, and this has caused has spurred volatility in the markets. We also expect economic releases, main economic releases from the UK this week, and we started earlier today with the employment report. So we'll talk a little bit about that, and we also had quite a few news around the oil market, and we're also gonna talk a little bit about Disney in the aftermath of last week's earnings results and restructuring plan. However, before we get into all of that, as always, please read carefully through the risk warning and the disclaimers. Once again, I urge you to read the disclaimers and the risk warnings carefully before we get the ball rolling. Okay, let's get started because we have quite a few things to cover. So as we're looking at Euro USD on the hourly chart, and you can see here the volatility that the US CPI data caused on the pair. So let's say that as we talked already about US CPI for January showed another moderation. It's now 5.6% year over year for the core and 6.4% year over year for the headline figure. Both of these are still the lowest in over a year, but they were also higher than expected, and that has caused some market volatility, and we need to see how markets settle around it. Before, however, we go into the technicals, let's talk about a few other things as well. Earlier in the day, we got a strong jobs report from the United Kingdom, and most importantly, wages excluding bonuses rose 6.7% in another for the 3-month period ended December. Again, this is the highest, the biggest increase outside the pandemic period, and we know that the Bank of England is worried about wage pressures and how this reflects into inflation, and we will be waiting more data from the old Albion over the next few days. We will talk about that at the last part of our session, as always, about what's coming ahead. We also got quite a few news around oil this week. We will expand later on as we will see the technical outlook of US oil, but the latest news was the monthly oil report from the Organization of the Petroleum Exporting Countries, known as OPEC, which increased its 2023 oil demand growth. Other than that, we also have quite a few things on the corporate world. We had Disney's earnings last week and restructuring plan. We'll get into that and the technical outlook of the stock following this report. Today, Ford announced the cut of nearly 4,000 jobs in Europe. And now let's get into Euro USD and the technical outlook. Allow me though to switch to the 4-hour chart. So the pair comes from 2 losing weeks, as the recent blockbuster jobs report from the United States caused markets to expect a higher terminal rate, which from the Fed, which has supported the greenback. We have seen a limited correction so far. This is it, and tested for a second time the 23.6% Fibonacci of the September low, February high recovery, this region that we highlight here. Now, daily close below this level will expose the pair to the 38% Fibo, but the downside seems well protected. We can also see a thick daily Ichimoku cloud protecting the downside. Now, the ECB, on the other hand, has delivered more tightening compared to the Fed, and it will likely do more in the coming months, and this is supportive of the Euro-USD pair. Furthermore, the correction so far has been limited and leaves room for new highs towards 1.1067, but we are cautious for further recovery that would take out 1.1233. Once again, we need to say that we saw two-way action after the CPI report, so and these data points also are taken into account by the Fed in its decision making. So we will need to see sort of where markets settle around these figures. Now let's move on into US oil and talk about the recent developments there. We already said we had today the Organization of Petroleum Exporting Countries actually increasing its oil demand growth for the current year. We have seen a series of such upgrades over the past few months, not only from OPEC, but from the International Energy Agency as well. We expect the update tomorrow there. Yesterday, oil was pressured because the United States said that they will sell 26 million barrels of crude oil from their strategic petroleum reserve, the SPR. And on Friday, Russia, in a surprise move, announced that it will cut production by 500,000 barrels per day in March. That had actually pushed oil prices higher on Friday, but we're seeing now that it's having a difficult week. This probably shows that Russia has been having some difficulties to supply oil, given the price caps we've seen from European Union and other Western countries. So we'll have to see how this goes. Now, on the technical front, not much has really changed since recent analysis we have provided. We can see that it now breaches the 200 period EMA, and this keeps the door open towards the region of 70 to 23, 70 around here, but we are struggling to see sustained weakness below this level given China's reopening and prospects for higher demand this year overall. And on the other hand, as we said, there are prospects that support oil prices, and we can see, we think there is room for another push towards 84.70, but again, some strong catalyst would be needed for that and moves even higher. And as the US indices are about to open, let's go to NAS 100, the tech heavy index. Once again, if we check here, you can see this two-way action caused after the US CPI report. but now we're seeing the index moving lower. Let's turn to the 4-hour chart for our analysis. The index dropped last week as markets have now embraced the Fed's terminal rate projection. For instance, CME's Fed Watch tool now actually assigns the highest probability to 5.5%, even higher than the previous higher pricing. We also had Chair Powell speaking last week. He still seemed to be a bit relaxed, let's say, about the Fed's tightening, but maybe he doesn't need to be particularly forceful, since he believes that financial conditions are now more well aligned, and I quote, more well aligned with the Fed's projected policy path. We would say, though, that given this higher pricing now, the index is resilient. Bulls remain at the driver's seat and can push towards 13,200 around this region here, but we are cautious still for further advance to the 13,724 region. Now, on the other hand, the index is exposed to this critical region we highlight here, around 12,000, which contains the 200-period EMA and the 38.2% Fibonacci of the December low, February high rebound. But further decline will need some catalyst that would bring the 11,000 mark in the spotlight. Markets have been optimistic in general about a less aggressive Fed. There has been some repricing, and this sort of contains the upside, but the Fed in any case has slowed down the pace of tightening, and markets are also looking forward, and we believe that there is room higher. And now I want to close with Disney, the entertainment giant. Let's take a look here. In light of the recent earnings report, we have written in detail in FXCM's market analysis page of your respective regions if you want to read more about that. But we will say that Disney Plus, the main streaming platform of Disney, relinquished 2.4 million users in the quarter that ended December. ESPN Plus and Hulu, the other two services, increased their subscriber base, but this was not enough to offset the Disney Plus losses. Now, all three services combined have 234.7 million users, still ahead of Netflix. Now, other than the streaming part, financials were strong. Revenues increased 8% from a year ago. The parks experience and product segment posted its 8th straight profitable quarter. And the new/old CEO, Bob Iger, who returned recently at the helm of the company, announced a restructuring plan to cut costs by 5.5 billion, and that of course involves 7,000 layoffs. Markets initially reacted positively to this, and you can see how the stock after the results hit 6-month highs, but ended the day lower in a broadly bad day for Wall Street, and it faces pressures again this week. In general, we believe that this restructuring plan can be helpful for the stock. We have seen markets reacting positively to any such news of cost cuts and layoffs. There is room for the stock DIS.US to hit higher highs at around 12660 and then look towards this region here which is the descending trend line from the 2021 highs, although we're still cautious about that. On the other hand, we can see that there is pressure and there is risk for a breach of the 200-period EMA around the $100 mark. And daily closes below this level would shift bias back to the downside and expose the pair to further losses, to the stock to further losses towards and below 90. So that's it from the technical outlook. As always, let's talk a little bit about what's ahead and until our next session on Thursday. We talked about the monthly oil report from OPEC. Tomorrow we expect the one from the International Energy Agency for more insights as to the state of the oil market. Also tomorrow on Wednesday we expect UK CPI inflation. It had eased in December to 10.5% for the headline reading, but the core was sticky at 6.3%. The bank expects CPI inflation headline to fall to around 4% towards the end of 2023. So we'll have to see what progress will be done. We also expect US retail sales and industrial productions again on Wednesday. Both those metrics had posted big declines in the previous month, lowest levels in around a year and even more. So again, this could potentially be important. Now, on Thursday, before our next US Open, we expect Australia employment figures. The labor market there is very tight, according to the RBA, the central bank of the country, while unemployment hovers around its lowest in 50 years. Now, on the earnings front, after markets close today, we expect Airbnb, and not much more around from the United States, but there are also Australian companies such as retail giant Wesfarmers, telecommunications behemoth Telstra, and more, and also some results from Europe, such as UK's Barclays and Europe's Airbus. So that's it for today's session. We will talk again on Thursday at the same time, 14:20 GMT, 10 minutes before US markets open. Thank you for joining. Bye-bye.